Turbulent times in financial markets, especially for bonds, as investors brace for the very first Fed rate hike in almost 10 years. Hi, I'm Mike Bernick for Money and Markets Extra. Previously, we've shared with you some investment strategies to help you profit in a climate of rising long-term interest rates. And today, our interest rate expert, Mike Larson, is here, editor of the Safe Money Report, to tell you about some smart steps you could take right now to save money with mortgage loan rates already on the rise. Mike, welcome.
Thanks, great to be here.
Well, the Fed hasn't raised rates just yet, but home mortgage loan rates, they're already on the rise in anticipation. So what can American homeowners do to save money in a rising rate environment?
Well, you're right. The average interest rate on a 30-year fixed mortgage loan has already surged to an average of around 4.25%. That's up from just 3.75% in the spring, like you can see on this chart.
Right.
So, if you were waiting around, kind of sitting on the fence to refinance your home loan, chances are you may be too late. But the good thing is that doesn't mean there aren't other ways you can still save mortgage money. And one that I definitely hope that you check out is seeing if your lender will remove your private mortgage insurance, or PMI.
First, explain exactly what PMI is, and then tell us how you can cut that cost.
Sure. PMI is insurance that doesn't really do anything for you. It protects your lender rather than you from losses if you default. If you put less than 20% down to buy your home, chances are you're probably paying PMI right now, and you may not even realize it. Now, the thing with PMI is the cost is going to vary depending on how high your loan-to-value ratio was. But this can easily run to as much as $100 to $200 a month on top of your normal mortgage payment. Now, it is true that your mortgage company will eliminate PMI automatically once you pay your loan down to 78% of the home's original value. Or you can request that they do that once you pay it down to a loan-to-value of 80%, again, of the original home value.
Right, but that can take many years, can't it, Mike, due to the way mortgage loans are amortized?
That's
in
right.
the early years, for example, a 30-year loan, most of your payment goes straight towards interest, not principal.
Yeah, that's right, absolutely. So it does take years. But here's the thing. Home values have appreciated in the large portion of the country over the past few years.
That's true. Yeah.
I mean, that's certainly true here in South Florida, which is where my wife and I signed a new construction contract to buy a home more than 3 years ago. So, I went ahead and checked with my mortgage company to see what their requirements would be to waive PMI much sooner.
And what did you find?
Yeah, it turns out I could get PMI eliminated if I met a couple of conditions. I had to have made 24 payments since origination, I had to have no 30-day late payments in the past year, and I needed a new appraisal that confirmed the property had appreciated enough that I was below that 80% loan-to-value level. The good news is we met all the criteria, so I sent in the form, I let the appraiser do his thing, and voila! Now my wife and I are going to be saving around $125 a month every month for as long as we have that mortgage.
Wow, that's an extra $1,500 a year in savings on your mortgage loan payment alone.
Yep.
Any other money-saving tips?
Well, sure. Another strategy worth considering is whether you want to fix the rate and payment on a portion of your home equity line of credit, or HELOC if you have one.
Wait a minute. Again, let's explain what the heck a HELOC is first.
I know there's a lot of acronyms here, PMI, HELOC, but to keep it simple, a HELOC is a type of variable rate home equity loan where you can access as little or as much of your home's equity over time at any time using a checkbook or a linked kind of Visa card. Now, most HELOC rates are tied to the prime rate, which in turn is linked at the hip to the short-term federal funds rate.
So if you have one of these loans right now, your rate is probably pretty low and hasn't changed at all with the Fed on hold, right?
That's right. I mean, the Fed hasn't done anything with the funds rate in years, but that's really in the past. If the Fed does what it says, follows the bond market's lead, and starts to raise short-term rates, then the HELOC rate you're going to be paying is going to rise too. And that's going to increase the cost of servicing any outstanding debt you have on that credit line.
So what should you do before that happens?
Well, you want to check with your bank to see if that bank allows you to fix the rate on a portion of your outstanding balance. A lot of banks offer that feature, and the fees are pretty minimal. If you get lower interest rate costs by fixing rates before the Fed raises rates, you could more than earn that money back, that fee that you pay up front, and lower interest costs over time.
Sounds like it.
Between this mortgage step and this HELOC step, there really are two simple strategies that make a lot of sense in a rising rate environment like we have today.
Indeed it does. And for more money-saving ideas, you have more tips or additional tips in next month's issue of the Safe Money Report, correct?
That's right. I'm going to be covering plenty more of these money-saving ideas in a lot of detail in the weeks ahead, so definitely stay tuned.
Thanks, Mike.
Thank you.
Well, there you have it. 2 timely tips for saving money with interest rates on the rise, courtesy of Mike Larson, editor of the Safe Money Report. Well, thanks for joining us on Money and Markets Extra today, and until next time, good investing.